Good morning, all, and a warm welcome to everyone to our latest economic forum. My name is Shumit Day Chowdhury, and I will be chairing today's forum. If we could just go to the next slide, please. You can see that we've got plenty of material that we'd like to take you through over the course of the next hour or so. Some might say enough to fill a halftime show. So you're going to be hearing firstly from Amy, who's going to be taking us through some of the latest insights on the state of the UK economy, particularly leading up to some of the material that you'll be hearing later this week with regards to inflation and labour market. She'll be just giving you some of that kind of material that we have. What do we know now about what policymakers and journalists might be looking at as part of a stock take on the UK economy? Then we're going to be hearing from Alex, who's going to be talking about a topic that's of, I imagine, interest to every one of us on the call now. It's probably the most topical theme that we have in economics, but particularly also looking at it from a National Statistical Institute reflection, which is around AI. This is one of those measurement challenges that are probably amongst the biggest that we currently face. And so Alex is going to take you through what do we know so far in terms of some of the information that we've collected from UK businesses, ranging from kind of AI inputs, which might be around adoption and use, but also then AI outputs. What do we know about some of the impacts on labour market and productivity? And this is very much one of our first efforts at looking at this, which we published today. And I'm sure we'll be coming back to this topic over the coming years. And then we're going to be here from Lee, who's going to take us through another topic of interest around family spending. And this will really cover not only what is it that we spend our money on, but also how does this vary across the distribution. So each of these speakers will kind of speak for around 10, 15 minutes or so. And then we'll have time for Q&A. And we'll do that via Slido. The code is 32514. I think we'll just put that in the Teams chat. So please feel free to post any reflections, any feedback that you have. And I'll try to get through as many as I can in the 15 minutes or so that we've got. And I'll just offer some closing remarks. So I'm going to hand over to Amy at this stage. So look, big welcome, and I look forward to your questions. Thank you very much.
Thanks, Shumit. Good morning, everyone. Yeah, my name's Amy Ditchfield, and I'm Head of Economic Analysis for Prices and GDP here at the ONS. So I'll take you through the latest on the state of the UK economy this morning. Next slide, please. So I'll start by looking at household spending. While retail sales only capture part of overall household consumption, they do provide a useful indicator of consumer demand and help us distinguish between spending driven by higher prices and spending driven by higher volumes. The chart on the left shows UK retail sales excluding automotive fuel in both value and volume terms, indexed to February 2020, which is the last full month before the COVID-19 pandemic. During the period from 2020 to 2022, retail sales values and volumes tracked closely. However, since 2022, a clear gap has emerged between the two series. Retail volumes have broadly flatlined, with volumes up only 1.5%, while the value of retail sales has risen by almost 28% since the base period of February 2020. This suggests that the majority of the increase in retail spending since the pandemic has been driven by higher prices rather than consumers buying more goods. In other words, households are spending more money overall, but purchasing roughly the same quantity of goods as they were before the pandemic. Looking at monthly data, retail sales volumes fell by 1.3% in April, the largest monthly decline in almost a year, and more than reversing March's gains of 0.6%. When excluding automotive fuel from the total, volumes still fell by 0.4%. This may indicate some continued pressure on household spending, although monthly retail sales data can be volatile. Given that household consumption is the largest component of UK GDP, weaker consumer spending would normally be expected to weigh on overall economic growth. However, the GDP data suggests that the wider economy has remained relatively resilient, with 3-month-on-3-month GDP growth of 0.7% in the latest figures released last week for May. This resilience is driven primarily by the services sector, which has made a consistently positive contribution to growth in recent months. There have also been some recovery in construction activity since the start of this year, providing additional support to growth. Next slide, please. Thank you. In May, the composite PMI fell into contraction territory for the first time since April 2025, largely driven by a decline in the services PMI and a weakening in manufacturing activity. while the manufacturing PMI remains above the neutral 50 mark, indicating a continued expansion. It is pointing to growth at a slower pace. As the composite PMI combines both the services and manufacturing sectors, and services account for a much larger share of the UK economy, the composite PMI and the services PMI tend to move closely together. While official output data shows some recovery earlier in the year, the forward-looking construction PMI continues to point to weakness in activity. The latest PMI reading of 38.4 remains well below the neutral 50 threshold and marks the 18th consecutive month of contraction. The chart on the right shows that UK businesses are still experiencing turnover challenges, with higher percentages reporting concerns around the cost of materials, competition, and the cost of labour. However, economic uncertainty does remain the most commonly cited challenge, with around 1 in 3 businesses identifying it as a challenge affecting their current turnover. These survey indicators suggest that businesses are facing a challenging operating environment, with weaker demand and ongoing cost pressures and uncertainty continuing to weigh on economic activity. Next slide, please. Thank you. So turning to inflation, price pressures have continued to ease so far this year. Headline CPI inflation fell to 2.8% in May, down from 3.4% in December. Core inflation, which excludes more volatile items such as food and energy, also declined from 3.2% to 2.6% over the same period. Alternative measures of inflation tell a similar story. The 15% trim mean has fallen from 3% to 2.4%, whilst median CPI has eased from 2.8 to 2.6%. This suggests that disinflation is becoming increasingly broad-based across the economy rather than being driven by a small number of volatile components. Whilst this may have given greater confidence that underlying inflationary pressures are continuing to fade, expectations are that renewed escalations of conflict in the Middle East could lead to higher inflation again. Previously, inflation was expected to reach the bank's 2% target in 2026, but recent developments in the Middle East could lead to increased inflation in the short term, with renewed pressure from energy before easing again. Households are signalling that they expect inflation to ease over the coming months. The chart on the right shows household inflation expectations for 1 and 5 years ahead. Following a sharp rise in February and March this year, likely linked to concerns around the conflict in the Middle East and its potential impact on energy prices, 1 year ahead inflation expectations have started to fall back. Households now expect inflation to average 3.8% over the next 12 months, down from 5.4% in March. 1 and 5 year inflation expectations are now broadly aligned, suggesting households do not expect a sustained pickup in inflation over the medium term. However, both measures remain above the current inflation rate, indicating that households still expect price growth to remain somewhat elevated. Recent developments could mean that these inflation expectations, particularly in the short term, could rise again, so we can see how these expectations change in the coming months. Next slide, please. A weaker labour market may be helping to reduce wage-related inflation pressures. The chart on the left shows CPI and nominal average weekly earnings, both indexed to February 2020, the last full month before the COVID-19 pandemic. During 2022 and much of 2023, inflation rose faster than wages, resulting in falling real wages. Since late 2023, however, earnings growth has strengthened relative to inflation. As shown by the lime green line moving above the navy line, cumulative growth in nominal earnings has now exceeded cumulative CPI inflation. The chart on the right shows that private sector regular pay growth, excluding bonuses, has continued to slow since the beginning of 2025. The navy line shows annual pay growth easing from around 6% at the start of 2025 to around 3% by early this year. Looking ahead, the Bank of England's projections and survey indicators, shown by the coloured markers, suggest that private sector regular pay growth is likely to remain in the region of 3 to 4% over the remainder of this year. This will be a slower rate of wage growth than we have seen in recent years and should help to support the continued moderation in underlying inflation. Next slide, please. Thank you. So moving on to consumer sentiment, confidence has improved slightly from April to June in the monthly readings, but the broader picture is that consumer confidence remains soft. Recent improvements have been driven mainly by households feeling more positive about their personal financial situation and the wider economic outlook over the next 12 months. As a result, the overall consumer confidence index increased to -23 in June. However, looking more widely, the time series shows that consumers' reflections on their personal economic situation over the next 12 months has been negative since April, shown by the light blue line on the left-hand chart being below zero. While the headline measure has improved, there are some interesting movements looking at a more granular level. For example, 16 to 29-year-olds typically are the most optimistic age group, but their confidence has fallen sharply in recent months. Their overall consumer confidence score has declined by 11 points in just 2 months and has now turned negative. This is reflecting a weaker view of both their personal finances and the broader economy. The chart on the right shows the household saving ratio. This estimates the amount of money households have available to save as a percentage of their total resources. Previously, this had been high and could have been a precautionary measure. However, since the start of 2025, the household saving ratio has generally been falling. This could indicate that households are feeling more confident about their financial outlook and therefore more willing to spend rather than save. In some cases, households may have been using money they'd previously saved to help fund their spending. Next slide, please. Thank you. So the chart on the left shows the price of Brent crude oil in US dollars per barrel. As we can see, prices rose sharply between February and April this year, coinciding with escalating conflict in the Middle East. More recently, oil prices have fallen back towards pre-conflict levels and were trading around $70 per barrel, but in the last week or so, these are rising again amid renewed tensions, and the price is just over $80 a barrel now. This highlights how sensitive oil markets are to geopolitical developments and the volatility that can result. Changes in oil prices feed through to UK households directly via energy costs and indirectly through goods and services, including food prices. However, the impact is not felt equally across households. The ONS household cost indices shows that inflation affects households differently across the income distribution. The chart on the right breaks down spending patterns for selected categories by income decile, with decile 2 presenting lower income households and decile 9 representing higher income households. Here, we can see that lower income households spend a much larger share of their budgets on essentials such as food and energy. As a result, they are more exposed when prices rise in these categories. Higher income households, by contrast, spend a smaller proportion of their income on essentials and have greater scope to adjust discretionary spending. This makes them better placed to absorb increases in the cost of living. This chart illustrates why inflationary shocks can have very different effects across the income distribution. Increases in food and energy prices tend to have a disproportionately larger burden on lower income households, whilst higher income households generally have greater flexibility to absorb these pressures. Next slide, please. Thank you. The chart on the left shows the UK public finances remain under pressure. In the first 2 months of the 26-27 financial year, public sector borrowing was higher than in the same period a year ago and also above the OBR's forecast. This is shown by the blue bars in the left-hand chart being above the green bars and the navy blue line in both April and May. Looking ahead, elevated borrowing costs represent an additional pressure on the fiscal position. This chart on the right shows 10-year government bond yields for the UK, US and Germany, with the UK yield currently the highest of the three. Higher bond yields increase the cost of issuing new government debt and refinancing debt as it matures. Over time, this can contribute to higher debt interest spending, making it more difficult to reduce borrowing. This suggests that the UK's fiscal position remains constrained, with borrowing running above forecasts and financing costs remaining relatively high. Next slide, please. So finally, we can look ahead to the outlook for 2026 as a whole. The chart on the left shows the average GDP forecast for 2026 from Treasury's monthly survey of independent forecasters. The latest average forecast for GDP growth is for 1.0% in 2026. This is the strongest consensus forecast since February, prior to the escalation of conflict in the Middle East. The chart on the right shows the corresponding average forecast for CPI inflation in 2026. The latest consensus forecast is for CPI inflation of 3.2%. Whilst this remains above the bank's 2% target, it is the lowest average forecast since March. These forecasts were collected between the 1st and the 10th of July and therefore do not incorporate the renewed escalation of conflict in the Middle East over the past week or so. As new information becomes available, it will be important to monitor how forecasters revise their expectations for growth and inflation through the remainder of this year. Next slide, please. Thank you. So to summarise, retail sales value growth continues to outpace volumes, which is highlighting subdued consumer demand. Inflation and inflation expectations are easing, while a weaker labour market continues to weigh on private sector pay growth. The household saving ratio has declined from its peak and consumer confidence remains soft. The composite PMI has fallen into modest contraction, whilst UK firms report heightened economic uncertainty as a turnover challenge, and gilt yields remain elevated and the UK finances remain under pressure. That's everything for me. I'll hand over to Alex. Thank you.
Thanks, Amy. Hi everyone, I'm Alex. This presentation is going to discuss artificial intelligence in UK businesses using data from the Business Insights and Conditions Survey, or BICS for short. The article informs how UK businesses are applying AI, the factors shaping its uptake, and highlights how it's been integrated into business activity and where its effects are emerging. Before turning to the findings, worth highlighting two key points. Firstly, BICS doesn't cover all sectors of the economy, so results may differ from those reported in other AI surveys. And second, some estimates in the article exclude the smallest businesses because their survey weights can disproportionately affect aggregate results. So I'll flag where this applies as we go through some of the analysis. Next slide, please. So the growing use of artificial intelligence across UK businesses has led to interest in understanding how it's been adopted, what it's used for in practice, what barriers business face in AI adoption and use, and potential impacts on business activity in the labour market. And while the measurement of AI is an evolving area in the UK and internationally, with national statistical institutes continuing to develop approaches to capture its use in businesses. Within the UK, BICS is currently the most comprehensive business survey, which collects timely information on AI from a business perspective, contributing to a wider international effort to better understand how AI is being used. Using data available from BICS, the article focuses on three key questions. Firstly, how widespread is AI adoption among businesses? Secondly, how are businesses using AI in practice and what impacts is AI beginning to have on business activity in the labour market? And finally, what factors are preventing or delaying AI adoption? And how are businesses responding to AI skill needs? So the charts I'll discuss will cover these different areas. Next slide, please. So looking first at the chart on the left, this shows the share of businesses with 10 or more employees reporting use of at least one AI technology. From this, we can see that AI adoption has continued to grow steadily. Since September 2023, the proportion of businesses reporting AI use has almost tripled, increasing from around 12% to 35%. And looking at the most recent BICS wave, we see that AI use varies by business size, with 28% of businesses with 0 to 9 employees reporting use of at least one AI technology, compared with 49% of those with 250 or more employees. The chart on the right then looks at a proxy measure of AI intensity, showing the average number of AI technologies used per AI adopting business. The chart, which also looks at businesses with 10 or more employees, shows that since September 2023, the average number of AI technologies used per business has increased only modestly, rising from around 1.4 to 1.6. However, we do acknowledge that the number of technologies used isn't a perfect proxy measure of AI intensity. For example, not all technologies are relevant to our business, and the measure also doesn't tell us how extensively AI is being used across an organization. So to address this, new questions added in the latest BICS wave look at the extent of AI use and the share of employees using AI. Next slide, please. So this slide shows AI use across industries. The blue bars represent business using AI for a single use case, while the green bars represent businesses using AI for 2 or more use cases. And together it gives us an indication of the level of AI use across industries in terms of overall adoption and intensity of use. Unlike the previous slide, the results include businesses across all size bands. So from the chart, we can see that AI adoption varies considerably across industries. Industries that are more generally knowledge-based or digitally intensive tend to have the highest levels of AI adoption. Information and communication stands out in particular, with around 58% of businesses reporting use of at least one AI technology. Private sector provision of education also reports relatively high adoption at around 51%, and in both these industries, a relatively large proportion of businesses report using multiple AI technologies, indicating more intensive adoption. At the other end of the scale, industries like construction report much lower levels of AI use, with only around 13% of businesses reporting adoption and little intensive use. Next slide, please. Looking at the chart on the left, this shows how businesses are using AI in practice. From this, we can see that improving business operations is the most commonly reported use of AI across all business size bands, where around 60% of AI using businesses report this as a use case, with smaller businesses showing slightly lower rates. Providing or personalizing products or services, this is the second most common use and is particularly noticeable among smaller businesses, with around 31% of businesses with 0 to 9 employees reporting this use. The chart on the right then looks at whether businesses using AI to improve business operations report different workforce outcomes compared to businesses using AI for other purposes, such as developing new products or services, exploring new markets, or providing or personalizing products and services to customers. In the chart, we see that businesses using AI for operational improvements are more likely to report a reduction in headcount, with around 6% reporting a decrease compared with a smaller proportion among businesses using AI for other purposes. However, the overall impact on employment appears limited. In both groups, the most common response is that AI has had no effect on workforce headcount. Around 63% of businesses using AI for operational improvements report no change in headcount, compared with around 52% of businesses using AI for other purposes. And these early indications show that the impact on employment remains limited at this stage. Next slide, please. So, this chart shows the business roles most affected by different AI technologies, including large language models for text generation, visual content creation, and machine learning applications for data and image processing. And the results include businesses across all size bands. For clarity, the chart focuses on the 4 roles most commonly reported as being affected, although impacts were also reported across a wider range of business functions. From the chart, the main message is that the roles affected vary depending on the type of AI technology being used. For example, visual content creation tools are the most commonly associated with impacts on creative and design roles, with over half of businesses using visual content creation AI reporting impacts. A different pattern is observed for data processing using machine learning, which is most strongly associated with impacts on administrative or clerical roles and data analysis roles. Image processing technologies, on the other hand, appear to have broader impacts across the different business roles. And overall, the findings suggest that the type of AI technology used appears to play an important role in shaping where these impacts are felt. Next slide, please. So looking at the chart on the left, this shows whether there have been any considerations that have prevented or delayed a business from adopting AI technologies in the last 3 months across business size bands, such as the level of expertise, cost, difficulty identifying business use cases. And from this, we see that a substantial proportion of businesses across size bands report no barriers, while among those that do experience challenges, the level of AI expertise is one of the most commonly reported barriers. And this is particularly evident among businesses with 100 to 249 employees, where around 18% report that insufficient expertise has delayed adoption. Cost is also a commonly reported constraint across all size bands, affecting around 7% to 14% of businesses. The chart on the right then compares businesses that report a lack of AI expertise as a barrier with businesses that have adopted AI but report no such barriers to its adoption, looking at the approach to integrating AI-related skills, with the results excluding businesses with 0 to 9 employees. One of the findings here is that businesses facing expertise gaps are much more likely to invest in training existing staff, with around 62% reporting training or retraining employees to develop AI-related skills, compared with around 26% of businesses reporting no barriers. And differences across other approaches to integrating AI-related skills are less pronounced. Businesses reporting no barriers are slightly more likely to automate or replace roles than those citing a lack of expertise, while recruiting new staff with AI-related skills and outsourcing roles remain relatively uncommon across both groups. Next slide, please. In summary, the charts presented from BICS data have shown that AI adoption has grown gradually since September 2023, but the depth has not changed considerably. AI use varies across industries. Improving operations is the most common AI use, but workforce impacts remain limited. Also shows that roles affected by AI vary depending on the type of AI technology being used. And finally, AI skill barriers appear to be driving investment in training or retraining staff. That's everything from me. Thank you very much.
Morning. Good morning. My name is Lee Colving. I'm the head of the micro household income and expenditure analysis in the Household Resilience Division team at the ONS. Next slide, please. So what's happened at the ONS in the last 12 months? So we've published the family spending financial year in 2025. OSR compliance review of the family spending statistics has occurred. ONS surveys and economic statistic improvement plan quarterly progress updated, which provided an overview of household financial recovery plans. That was published last week. And in the survey world, we have ongoing quality work to better align our accredited household income and spend statistics. And in process and methods, in financial year 2025, we updated the equalization approach for the family spending article to use the modified OECD two-person reference household instead of a single-person approach. Next slide, please. On the survey developments, we've implementation of the OSR recommendations. We have focused on the delivery of 3-year quality recovery plan. We continue to improve our production pipelines to move away from legacy systems and improve cross-cutting insights of household income and expenditure statistics at the micro level. The statistical publications with the family spending, as I said, has gone out financial year ended 2026, is planning for spring 2027, aiming to bring closer to 12-month target between the data collection and the publication as recommended by the OSR review. Stakeholder engagement strategy is going to be published, and the engagement mechanisms of income and expenditure is currently under review. Next slide, please. So now I'm going to talk through a little bit about the OSR review of the LCF and the family spending, which took place on the 10th of February 2026. They recognise the challenges we face in our data collection in the living cost and food survey and the family, which is the family spending data source, and acknowledged the range of interventions and developments we have in place. The conclusions were that while there have been growing issues around the achieved sample size and timeliness, considering the positive user feedback and the current and planned improvements to these to the survey, these statistics remain sufficient value and quality to meet users' needs. The confirmed family spending statistics continue to comply with the Code of Practice for Statistics and can be continued to be published as accredited official statistics. 3 recommendations were made on variable continuity information, timeliness, and quality reporting. Next slide, please. Now I'm going to take you into some of the analysis that came out of the financial year ending 2025 family spending data set. What we're going to look at here now is what are the households spending the most on, how is expenditure changed across the income distribution, and how is the expenditure compared with financial year ending 2023, which on the top and bottom fifth of the households changed. And unless otherwise stated, in this presentation, it is year-on-year changes. The achieved sample for the financial year in 2025 was approximately 5,000 households. Next slide, please. After adjusting for inflation, the average weekly household expenditure increased by 5% during financial year in 2025. The average weekly household expenditure increased to £676.60, and there was a nominal increase of £53.30 or 9% from financial year in 2024. After accounting for inflation, there was a real terms increase of £35.10, which was 5%. Weekly house expenditure in the financial year in 2025 still remains £75.60 or 10% per week lower than in the financial year ending in 2020. Next slide, please. We start looking at where the biggest increases were across the COICOP categories. After adjusting for inflation, household spending increased across most COICOP categories this year, which is a bit of a change from the previous year, with the largest increases coming in transport at £8.10, 9%, This was mainly driven by the purchase of vehicles with a 23% increase, or £7.10 increase in that, particularly driven by purchase second-hand vehicles, which was £5.10 or a 25% increase. There was a small increase in transport services of around 5% or £1.10 a week. Recreation and culture was the second largest increase, with a £6.70 increase of 9%. And this was mainly driven by recreational cultural services, which increased by £2 a week or 9%. And an increase in package holidays of £4.20 or 13%, particularly package holidays abroad, which out of the £4.20 were made up of £4.10 or 14%. The third largest increase was in the restaurant in hotels, which was £2.80 or 6%. And this was mainly driven by restaurant cafe meals with a 9% increase or £1.40. Housing, net, fuel and power was the fourth largest category to increase, with £5.60 or 5%, mainly driven by a 6% increase or £3.30 in net rent, and a 7% increase or £2.20 in electricity, gas and other fuels. Next slide, please. Where we look at where households spend the largest portion of their expenditure, these remain pretty static with the years before, which is housing, net, fuel and power is the largest share at 18% of total expenditure, or £118.40 a week. Transport the second, which is 14%, or £96.40 a week. Recreation and culture then at 12% at £82.10, and food and non-alcoholic drinks at 11%, or £73.70. Next slide, please. When we start looking at the difference in weekly expenditure between the richest and the poorest fifth of households, this has widened in the financial year ending 2025. The richest fifth spent about £1,083.60 a week, which is 2.7 times the poorest fifth of households, who only spent £407.30 a week in the financial year in 2025. The difference in the spending between the poorest, which is fifth of households, has reached its widest level since the financial year in 2021, increasing from 2.5 times to 2.7 times. Where the richest in the financial year in 2025 increases spending by £98.10 a week, or 10%, twice that of the poorest, which only increased their spending in financial year in 2025 by £18.10 or 5% a week. Next slide, please. Where we look at where the proportion of the total expenditure across the richest and bottom fifth of households are. The poorest households spend proportionally more on housing, net, fuel and power than the richer households, with the poorest spending about £104.70 or 25.7% of the total expenditure going on housing, net, fuel and power. And food and non-alcoholic drinks then, it's £61.80, 15.2% of the total expenditure. And thirdly, on transport, which is £41.80, 10.3%. The poorest households, housing, net and fuel power is mainly made up from the net rent, as mostly renters in this part of the distribution, at about £83.30 a week on rent, or that made up 53.6% of the overall housing, net and fuel and power value. For food and non-alcoholic drinks, 91% of the £61 went on just food, which is £56.50. And on transport, most of their expenditure for the poorest households went on the operations of personal transport, which made up 39.4% of their total expenditure on transport at £16.50. For the richest households, we have a slightly different picture because they tend to be homeowners, and most of the expenditure goes on other expenditure, which is £178.80 or 16.5% of the total expenditure. And this is mainly on mortgage interest payments, which was £71.80 or 40% of the overall other expenditure total. Transport then was the second highest expenditure of £174.60 or 16.1%. And this mainly went on purchase of motor vehicles, about £80 a week, which made up 45.8% of their overall transport expenditure. And for recreation and culture, they spend £145.10 a week, or 13.4% of total expenditure. And that was mainly on package holidays, which was £64.70 or 44.5% of their spending on recreation and culture. Next slide, please. Now, How has spending patterns changed since the financial year in 2023? In early 2021, UK inflation rates began increasing as the global economy reopened from the COVID-19 pandemic. By October 2022, supply chain disruptions and surging energy costs pushed CPI and CPIH inflation rates to levels high seen over the last 40 years. Now, when we decided to have a look at how household spending has changed since this period, the analysis for the financial year in 2025 family spending publication showed that household spending patterns had changed since the financial year ending 2023, which captured the highest inflation rates. Since the financial year ending 2023 inflation peak, spending has shifted unevenly between poorest and the richest fifth of households. Next slide, please. When we look at the pattern of expenditure changes between the richest and poorest households, which you see on the chart here, spending has increased more for the richest fifth than the poorest fifth of households across most expenditure categories since the financial year in 2023. The poorest fifth of households saw the largest real-term increases in the housing, fuel and power of 6%, of £5.90 compared to financial year in 2023. In food and alcoholic drinks, which is £3.20 increase, or again a 5% increase since financial year 2023, and recreation culture, we saw a 20% increase of £6.20. Most of the expenditure increases along the poorest households seem to just be maintaining living conditions. With the richest fifth of households, they're just increasing expenditure across all categories, particularly in transport, which is £46.20 or 36%, and the recreation culture, they increased by £26.20 or 22% compared to financial year in 2023, and miscellaneous goods and services, which is £15.80 or 24%. For the poorest fifth of households, the household fuel and power increases were mainly driven again by increases in energy, in electricity, gas and other fuels, of a 6% increase, or £4.20 a week. Again, for food, most of the increases coming from the just expenditure on food, with a 5% increase, which made up most of that. You got the recreational culture for them, which is coming from package holidays abroad, which is 53% of the recreational culture increase, of about £3.80 a week. Where again, similar pattern we're seeing in the richest fifth of households, they're purchasing more vehicles in transport. They've increased expenditure of £33.34 a week, or a 71.5% increase compared to 2023. They're spending a lot more on package holidays aboard, increasing by £10.40 or 19.1%. And for miscellaneous goods and services, they're paying a lot more on insurances. So about £7.50 a week more, or 23% increase. Next slide, please. Thank you for your time. If you have any questions, please email the family spending inbox.
Thank you very much there to our speakers.